Welcome back to Ben's Book Club. Today we are diving into the book The Quick Start Guide to Investing. Learn how to invest simpler, smarter, and sooner. I am absolutely thrilled to be your guide today as we walk through this incredible, no-nonsense roadmap put together by authors Glen James and Nick Bradley. You know, if you've ever felt completely intimidated by the stock market, just take a deep breath right now. We're going to take this step by step together, and we're going to transform you from a cautious saver into a highly confident investor.
So it's totally normal as a beginner to feel a real sense of fear or even paralysis when you look at the share market. Actually, a lot of people treat it exactly like a casino. But here is the real truth. Investing is not about getting rich quick. It's not rolling the dice on some random stock tip you heard, and it's definitely not staring at chaotic charts all day. When you buy shares, you are literally buying a piece of a real productive business. Ultimately, it's simply the most reliable system we have for buying back your future freedom. The authors share a brilliant philosophy here that I absolutely love. Complexity is the enemy of action. Waiting around until you think you know absolutely everything before you begin, that's a massive mistake. The financial industry has been gatekept by confusing jargon for way too long, but today we're bypassing all of that. We are going to build a completely simple, gatekeeper-free system. You don't need to be a financial genius, you just need a plan that actually gets you to take action.
Okay, so here's the simple roadmap we'll use to cross that threshold together. First, we'll find your investing why. Then, we'll look at the true cost of waiting, set up your core and satellite strategy, learn to automate and ignore the noise, and finally, we'll draft your very own investing constitution.
Step 1. Find your investing why, which is all about building your emotional bedrock.
Before you touch any apps or brokers or stocks, you absolutely must define this foundation. This is the critical psychological work that stops you from panic selling the moment the market has a natural dip. If your only goal is just to get rich, well, your strategy lacks emotional staying power. The moment your portfolio drops in value, fear takes over and you sell. But if you shift your mindset to long-term freedom, investing so you can control your own time, support your family, or retire comfortably, that gives you the emotional bedrock you need to weather any economic storm.
Moving right along to step 2, the cost of waiting, where we prioritize math over myth.
Let's tackle the absolute biggest roadblock beginners face, that deeply ingrained, kind of comforting lie that you can just start later when you're making a higher salary. The crucial point here is that time is your greatest asset. Why? Because of this beautiful snowball effect known as compound growth. This is when your initial investment earns a return, and then those returns start earning their own returns. It's like a giant snowball rolling down a hill, picking up speed. It is the absolute core engine of long-term wealth, and it desperately needs years to perform its magic.
Hundreds of thousands of dollars. That staggering figure represents the exact wealth you sacrifice simply by waiting to start investing from age 25 to 35. That is compound interest working in reverse against you. Every single year you wait is a year of exponential growth that you simply never get back.
Just take a look at the difference here between investor A, who starts at 25, versus investor B, starting at 35. This proves exactly why starting sooner with a small amount drastically beats starting later with a big chunk of cash. Even if investor B decides to contribute heavily in their later years, they can almost never catch up to the sheer mathematical advantage that investor A locked in just by starting early.
All right, step 3, core and satellite strategy. This is the engine of your wealth.
Now that we know exactly why we need to start immediately, let's demystify how to actually do it using the framework Glenn and Nick outline. To do this without all the dense jargon, we first need to understand the ultimate tool for beginners, the ETF. What is it? Well, buying an ETF instantly spreads your risk across hundreds of real companies. Instead of trying to guess which single company is going to win out, you just buy a single basket that holds the top 200 or 500 companies in the whole economy. Boom. Instant, low-cost diversification.
The authors highly recommend a strategy that is incredibly straightforward. Split your portfolio into 2 zones. The core is your boring, reliable, set-and-forget wealth builder made up of those broad market ETFs we just talked about. The satellite is where you get to have some calculated fun, things like single shares or thematic investing. The real magic here is that you are keeping the risky trading completely quarantined in a small bucket so it never wrecks your foundational wealth.
When you visualize it like this, it proves you don't have to give up those fun, calculated bets. As long as 70 to 90% of your portfolio is anchored safely in the core, you're good. You get the thrill of expressing your market views with your small satellite slice, while your core silently does all the heavy lifting for your future freedom. Step 4. Automate and ignore noise.
Time to build your behavioral armor.
We really need to armor you against the endless debate from the finance bros online, the flashy news headlines, and all those microscopic fee optimizations that just cause analysis paralysis. Your very best shield is dollar cost averaging. By automating a fixed monthly contribution, you completely remove human emotion from the equation. You don't have to stress about whether the market is too high or too low today. You just set up an automatic transfer, and you naturally buy more shares when the market is on sale and fewer when it's expensive. It's a brilliant, self-correcting system.
Now, while I do want you to ignore most of the online noise, you absolutely must pay attention to fees. Over a 30-year period, that seemingly tiny percentage difference between a 0.20% fee and a 2.0% fee silently kills your returns. It literally robs you of tens of thousands of dollars. Sticking to low-cost ETFs keeps your hard-earned money compounding for you instead of paying for some active fund manager's new yacht.
Here's a stark truth you need to remember. When the market dips, those are just sales on stocks. Every single major crash in history has eventually recovered to new highs. The worst possible thing you can do is panic sell. If you followed our earlier steps, your core is already automated. You don't even need to look at it. You simply stay the course.
Which brings us to step 5, your investing constitution. Let's draft your personal rules.
To make sure you actually survive those scary market downturns without doing something disastrous, the authors insist you write down a personal constitution while you are in a calm state of mind. Writing these exact rules down acts as a behavioral circuit breaker for your brain when the news gets scary. When a headline is screaming that the economy is crashing, you don't have to make a panic decision. You simply pull out this written document. You remind yourself, I don't check my portfolio daily, my investments are automatic, and dips are an opportunity.
And as a quick bonus tip before we wrap this explainer up, please do not ignore the massive wealth that is already sitting in your name. Whether it's your superannuation in Australia, a 401k in the US, or a similar retirement account, simply logging in to switch it from a conservative setting to a high-growth option could literally be the highest return hour of your entire life. Treat it as the foundational core investment that it is. We've built the foundation, established the strategy, and given you the rules to protect yourself. So I have to ask, if every single year you wait costs you your future freedom, what exactly is stopping you from starting today? You have the roadmap now. The very next step is simply to begin. Thank you for joining me for this explainer. Subscribe so you don't miss an episode.